Hey guys, Doug the Retirement Guy. Should I invest into the NEO's NASDAQ 100 High Income ETF, the QQQI, for my retirement account? Well, the dividend yield shows a nice QQQI of 14.02%. Very interesting stuff. We're going to cover that today. But man, before we get into this, I want to say thank you to each and every one of you. We've hit that subscribe button. We've had so many new subscribers to this channel. It's really starting to take off. We appreciate it, and we say thank you to you. Something new and exciting that we have also, you want to help support the channel, look down in the description. You'll see a nice little click to the Patreon tab for us. A simple $1, $2, $3, $5 donation would be phenomenal to help out the channel, keep us growing, keep giving us bright information that you're asking for. Again, let's get into the video. The NEOS NASDAQ 100 High Income ETF. This fund seeks to distribute high monthly income generated from basically covering calls of the NASDAQ 100. NEOS does a great job with selling up their options and also doing things with the tax, control their tax harvesting that they do. They produce a monthly dividend, 14.02% yearly type program. The neat thing about this company is their expense ratios are always low at 0.68%, and their 30-day yield is 0.12. Let's take a look at the holdings that they have. Now, this is one that got me, is the NASDAQ 100, which is the top 100 companies. They have 104 holdings. So they are trying to follow the big boys. They're trying to follow what the NASDAQ is doing. But they've added a few extra little accounts in there to get them to 104. This here just shows you the top 100 or top 10 of their portfolio. And you can see Broadcom on there, which was kind of threw me for a minute. So they're not always just doing all the high tech stuff. Costco's in there, Tesla's in there. They got some nice variety that they've added into it, and it's a well mixed package across the board. So why QQI? Well, they have a strong 24.33% total return, and that should be very strong for everybody. 24.33% return is over a specific period, and that includes all your dividends, interest, capital gains across the board. Now, their SEC rating is 0.12, and this is showing how much money that you should have coming in on a monthly basis. It's going to be low because they're constantly turning their stockpile of stocks. They're constantly turning the stuff, so it makes it harder to get a good track history off of that 30-day program as they're selling and turning so much. Their dividend, 14.02%, I was quite impressed with. When you come down with the cash flow for a retirement account, 14% is not bad. That means you're getting a 10% return on your money. They offer that monthly dividend payout, and there's multiple things you can do with the monthly dividends. We're excited about monthly. We think that's the minimum. If you want to have a retirement account living off of dividends, you got to have monthly dividend payouts. Because two things you can do. The first one, you can reinvest those potential dividend payouts and put that back into the stock, or maybe put it in a different stock, and constantly generate more income from those dividends. On the channel, we like the regular cash flow. We got bills to pay, we got bills coming in every month, and we're getting money in every month. So we can cover it both ways. Now, the fund has only been out since January of 24. So we just broke the 1 year mark. So we have a limited track history of what this fund is all about. We get into the return side of it. Now, 1 month out, 2.26. 3 months out, 8.06. Very impressive. 6 months, they're at 12.55. And each one of these are virtually equal to or just a touch above what the NASDAQ 100 is actually, the index is actually doing. And then 1 year out, they're 24.33. And since inception, 21.97. So very, very strong, very accurate numbers. So what we did, we said, let's put the $10,000 program into it, reinvest into the program. So back in January 30th, the shares were $49.84. We put $10,000 into it. We had 200.65 shares that were bought. If we go fast forward, the stock value, we gained 7.05% from the stock return. That is very impressive. In 1 year, we're getting 7% of our value increased. On top of that, we picked up 10.33% in dividend return, which equals out to be about $1,032. So they pay a nice steady 59 to 62, 63 cent dividend each and every month. So we have a nice cash flow across the board. A total return of 17.38%. So let's take a look at the line chart, how the value of this stock is handled over time. QQQI comes into what we call a mountain climber. And that is you're going to start at a certain point and you're going to start climbing up a hill to where you get to the top of the hill and you see the next hill that you want to climb, which means you have to go down to go up. So you get up to the next hill. Oh, there's the next peak. You got to go down to go up. And then it's got just all the way rocketing up to the very top point. The average price of this share is $50.92. So right now it's selling well above that average price. The kicker on this one, though, is Morningstar's risk came out at 72, which is extremely aggressive. And that kind of put a little damper on things. We said, oh, I don't know if I want to have that much aggressiveness in my retirement account. So in summary, the QQI summary is this. The stock return, 7.5%. But that's a positive. That's right on line. I love to get something that's equal to, if not higher than, inflation rate. So if you use an inflation rate 2, 3, or 4%, if you're anything above those, man, your stock fund is going to continue to grow. Your account balance is going to grow. Plus, you're going to get the nice dividend return of 10.33%. Now, here's the thing. I started doing this after adding into the comparison of the risk factor that Morningstar says. And then I started looking at this and saying, well, we're getting 10.33%. It's a nice cash flow, but we've seen better performers with less risk. So I start questioning is, you know what? Is this really a fund you want to have in your retirement account? We're going to give it a thumbs up, but we're already on the fence questioning, do what we want to do. Your total return of 17.38%, including your dividends over 12 months, is definitely a thumbs up program there. So this looks good on basic paper. But the question always is QQI good for a retirement account? And the answer is going to be no. A 10.33% return on the dividend is good. Like I've said, we've seen better. I give you right off the top, SPYI. SPYI is paying a 12% with a 6% positive cash flow, and its risk value was lower. The value growth is nice at 703, but here's the other thing. Retirees want income. So this thing should, they should be changing this thing over to a 7% growth. You should be getting a 12% dividend with maybe a 5% growth. But here's the kicker that I come into why I really had to give it a no. The risk level is too high for our liking. We can do better with lower risk ETFs. So with that risk level, I just couldn't say yes to this fund to have in a retirement account. We offer different things out there. We can show you which ones you want to be into. So I, again, am going to have to say no on QQQI. And we put that as a hold because it's a good fund to be in, but not for a retirement account.
I hope this information comes to you, helping you out making that decision. This is Doug, the retirement guy. If you like what we're doing, man, just give us that thumbs up. It helps the channel across the board. Hit that subscribe button. Don't miss a single video that we produce. And you know what? Leave comments down below. This video came to you from one of our viewers who left a comment and said, could you do a review on this? I'd like to see if this one's worth being involved into. And so we hopefully give that information that you need. Everything helps grow the channel. Guys, I thank you and look forward to talking to you next time.